As we enter the final stretch of 2025, markets have been on relatively good form, regaining much of the AI-led losses that we had been seeing at the beginning of November. Nonetheless, there's still question marks. And certainly we come into the territory where everyone starts asking whether we're about to see a Santa rally. So let's look into the numbers behind the Santa rally, ask us exactly what it is, why it might happen, and whether we're going to see it again this year. So first and foremost, we can see here that if you look from a historical perspective over roughly the last 75 years, December isn't necessarily the strongest month of the year, but over that time frame, it's the most likely to be positive. Now, there's caveats to this, as we'll see in a second, but certainly there is a perception that December is a relatively good month for stocks. Now, why would this be? December itself isn't necessarily a standout period of time. The one thing that you would look at within it is the fact that we see lower volumes and therefore the possibility of volatility off the back of that, because of course there's many days where people are going to be taking off. That has the propensity to move markets. You also have the fact that it's the year end, and the year end is when you see your benchmarking come to a close and you start to compare your performance as a fund manager to other fund managers and funds. And therefore, people are desperate to try and get that last boost at the end of the year. So there's, to some extent, window dressing that goes on where people essentially are trying to adjust their positions to try and get that last boost and return a stronger figure for the year itself. That may only be relatively short term in nature around some of the positioning for that period. And that might explain why we do see some movements occurring in the final stretch. Now, the Santa rally itself is supposed to be the final 5 trading days of the year, plus the first 2 of the new year. So it kind of accounts for that period where there's low volumes, the possibility of higher volatility because of that, and the movement where people sort of want to make adjustments right at the end of the year and then sort of shifting soon enough back into the new year once things have resumed. Like you can see here, generally the year end is a strong time for markets. And if you look from a sort of absolute basis, it's usually November that's best for equity markets, or for the S&P 500 we're looking at here. But of course, the month just gone, we did see significant jitters at the back end of earnings season. We saw strong earnings from big tech, but these questions emerging around the overvaluation of particularly Mag 7, but tech names essentially, the AI boom. When's it going to come to an end? Throughout that period, I was saying, as long as we're seeing really strong earnings, is there a justification of an absolute collapse? I don't necessarily see it, but maybe it happens. Maybe it happens. But we didn't see that. Instead, we saw the recovery, and we've seen the S&P 500 essentially move within 1% of record highs. If you look at the seasonal performance here, this is over the past 25 years. In actual fact, December certainly doesn't perform as well. And so it highlights the idea that December isn't necessarily as reliable a performer as the likes of November in particular. But of course, like I said, if you've seen a weak November, then maybe it heightens the likeliness of December being relatively strong. But November was weak at a period of time, and then we regained some of that ground. Of course, we've just seen the latest FOMC rate decision. They cut rates, but they are indicating only one rate cut for the year ahead. They decided to enact a new program where they're going to be buying T-bills. So there's a little bit for everyone. Crucially, we saw a significant upgrade in terms of the GDP outlook for 2026. That provides the basis for strength within other parts of the US market, not just the tech sector. And I think that is going to be key, because I think if we do see strength in terms of US equity markets, it's likely to be driven by the rest of the market and not just tech. We have just seen Oracle earnings coming out, underperformance in terms of revenues, strong data center spending, and all of that has led to people selling the stock down 12% pre-market as I speak. And this again raises concerns around the tech sector. So whilst we saw that tech sell-off, and we saw the recovery again led by the tech sector as people were buying the dip for many of these big names, once we get back to that point where the valuations were where they were, you start to ask questions once again. And that's why I do think if we are to see strength, it's likely to be for the rest of the market. GDP is expected to be strong next year for the US, and you've got the prospect of an uplift for the rest of the markets. And certainly if you look in terms of the earnings outlook for, say, Mag 7 versus the rest, this year, and it didn't happen this year, so it shifted to next year, but it was supposed to be this year, was the year where we were supposed to see a really significant surge in terms of earnings for the rest of the market and a pullback in terms of earnings growth for the Mag 7 names. That has been shunted back somewhat, but there is an expectation that we see the rest of the S&P 500, so the 493s, doing particularly well. So certainly an area to look out on, and a question mark around the strength of the NASDAQ over the S&P 500. I probably favor the S&P. Notably, what we have seen in the past is when we're looking at the performance of December, you've seen it on those two previous slides. Sometimes it's questionable. You look over a longer time frame, it has been relatively strong. But if you look in terms of this chart here, you can see that often, irrespective of whether you see a weak period at the beginning of the month or whether you see a sort of largely flat period at the beginning of the month, typically it's the back end of the month. So the final, as we see here, sort of 5 trading days of the year that we see strength. So that would tally up with the idea of a Santa rally. Now, what have we been seeing thus far? In actual fact, for the past sort of 5 trading days, we've been sort of largely trading water. Yeah, we saw a bit of strength at the beginning, but certainly we've sort of seen a little bit of a pullback in terms of some of the upside momentum that had been in place leading us into 2026. So December, we started the month off the back of a very strong November. But whilst we've seen a little bit of upside, it's not necessarily been to the same degree as we'd previously seen. So as you can see here, this is specifically within the Santa Claus rally period, and it's not hugely consistent. It's not like every year you see strength, but you would say that by and large, we see more up than down. The thing to note about that is generally markets go up more than they go down, right? So that would be expected to an extent, but you can see the last 2 occasions that we have on this chart, not necessarily great. The average since 1928 is 1.2% return. The average over the past 25 years is 0.5% essentially. So by and large, the sort of effect isn't great, but it is still positive for that period over the past 25 years, albeit at 0.55% return. So it's questionable, but there is still some sort of upward effect over that period historically. Now, let's look and see exactly where we are in terms of the S&P 500 at the moment. Let me just get my head out of the way. So what we can see here is, like I said, we've seen this run up at the back end of November, right? So we saw the sell-off in early November. We regained much of that ground over just basically a week. And now we've been sort of treading water. There's significant question marks here over whether the momentum's going to last. One notable thing here is this is the number of constituents of the S&P 500 with their price action above the 50-day moving average here, right? So the higher this is, the wider breadth of the move. The lower it is, the fewer stocks that are actually driving this. And so this is really a nod to the idea of, is this just a tech story or not? And what we've seen here really is this sort of breakout in that recovery in November. And so that points towards the recovery not necessarily just being the tech stocks. So we saw the sell-off, and then the rebound actually saw the rest of the market also getting into that as well. So that has been a healthy move. So that flush down and rally has been a healthy move in terms of greater breadth within the market. Then within December, in actual fact, we've been seeing a lessening of that breadth, a sort of pullback in this indicator. But now it almost looks like a sort of flag formation, right? It's kind of primed to move higher. And that's why I'm saying that I think there's a good chance that if we do see that strength, it's going to be for the wider market move rather than a tech-led story. In terms of momentum here, we can see on the 4-hour chart, things are starting to look a little bit weak. Hourly time frame shows you the volatility we've seen of late, but you can see here with the intraday chart, right? You can see some concerns because that trend of high highs and high lows then starts reversing with the breakdown to the lower high, the lower low. And then we see that rally coming into play around that FOMC meeting, the initial rally, the sell-off coming in around that Oracle news, and then we start to regain some ground. So certainly at the moment, we're in the realms of question marks because we've got the higher high, the lower low. And so markets, there's quite a bit of indecision over exactly where we go from here. You've got to say, though, certainly with the fact that we've broken up through that swing high here, there is a possibility that this is a short-term move before we retrace the wider. And therefore, what I would say is if we want to look at this from a sort of bearish perspective, 67.90 is the level I'd need to see broken for me to start thinking we're going to see a wider pullback coming into play. Let's see if the fib tallies up with that story. Absolutely perfectly. So let's just get the 61.8 off of that. Where are we? There we go. So we've come into, so like I was saying, we had that hourly upper trend here, high highs, higher lows. Then we break out of that pattern, but then we pull back into the 76.4 of this wider move. And now we're starting to see the bulls coming back into play. That points towards a possibility of another leg higher coming into play here for the S&P 500. So does the Santa rally exist? Well, just about, up 0.55% over that period on average over the past 25 years. Are we going to see it again this year? There's certainly been some jitters, most notably around the AI story and the tech space. So keep an eye out on that. But certainly with signs that we're maybe priming ourselves for another leg higher in terms of market breadth, and the fact that we've pulled into the 76.4 fib and started to see some strength once again, I wouldn't be surprised to see further gains as we move towards the back end of the year and start to try and move into and hopefully through that record high around 69.20. But I don't necessarily expect this kind of move, right? It might just be a gradual move higher, and in which case that would align with a similar kind of story to those numbers, right? 0.5% gain over that period, not necessarily sort of market exuberance. Well, we've just seen the last rate cut for a while now. Earnings were relatively strong. You can take some solace from the fact that we're seeing the sort of balance sheet expansion from the Federal Reserve, but there's question marks around the jobs market still. There's still some jitters within the markets around the AI space in particular. So that, I think, is going to hinder the ability to see sort of a really strong move upwards from here. But as things stand, the uptrend seen since the lows here on the 21st of November do still stand. I hope that's been useful. Make sure to like, subscribe, and follow for more content like this.